understanding of the basics on how to read them, because they're going to give you important information about one of the most important aspects of insurance, the money. So it's important to be able to explain the insurance math to your clients when they ask for a breakdown. So we're going to dive in a little bit and really just get a general overview. We're not going to dive into some of the complexities, but I want you to know how to explain the insurance so that you're able to answer some of those questions for your homeowners. So we're going to start here with a little exercise on page 19 in your workbooks. Go ahead and take a look at that. There is a 5-question self-assessment. I'm going to give you a minute or two to take a look and answer those questions, and then we're going to go over them. Okay, so answer those questions in the book, or at least have an idea of how you want to answer, because I'm going to be asking for volunteers here. And again, you're going to find that on page 19.
Scope of repair.
I'll save you guys my own embarrassment of singing for you. I won't hum the Jeopardy tune. So just think that in your head. All right, one more minute here. All right. So someone tell me in your own words, what is a statement of loss? How would you explain what that is? All right, Tara.
I would say it's an itemized list of the materials or services that to restore the property.
Okay, so that's a good idea. But so what we're talking about here is a statement of loss from the insurance carrier. So just to elaborate on that a little bit more, it would be what they've extended coverage for, and the itemized list of how they anticipate it's going to take to repair or replace the covered item. Right. So it's the carrier's document showing what they're paying for. And you may also hear of it called insurance paperwork, or an SOL, or an insurance scope, or scope of loss, right? Different things. Statement of loss, scope, all kind of refer to the same thing. So someone tell me, remember, raise your hands and I'll allow you to unmute if you don't have the capability to. What does RCV and ACV stand for? All right, Victoria.
Yes, so RCV is going to stand for replacement cost of value, and ACV is actual cost of value.
Perfect. Yes, great job, Victoria. All right, DOM Roofing and Restoration, or DOM Roofing and Restoration. I'm going to allow you to talk because I want you to elaborate. What's the difference between these?
Hey, the RCV is the replacement cost value, how much costs to restore the property at today's day, and the ACV is the amount that is depreciated over the years.
Mm-hmm.
Yeah, that's a great description. Exactly. RCV is today's cost, and ACV is, of course, discounting it based on its use. Great. All right. So how can you identify that something is an RCV policy? Let's see some hands. All right, Don Roofing.
Probably that's the easiest way for me to understand. Usually if an amount is not recoverable, you'll see it mentioned in, how do I say, in special, it's like square, little square lines, how you call them? Sorry.
Yes. All right. So you're talking about chevrons. They look
Yes.
like alligator
I didn't
claws.
know the right word. Yes.
That's okay. Yeah. So I think of them like your little alligator chompers.
Yes.
They're eating up that depreciation. Perfect. Yes. So, and we're going to look at this in a little more detail. I like doing that self-assessment here because it gives us an idea of where our gaps are. Oh, and one more question here. Oh, two more questions. All right. Let's see here. What is depreciation? So we've talked about, whether it's recoverable or not. What is depreciation? Somebody tell me. Nicholas.
That's going to be the loss in value of a particular item over its lifespan. So for instance, if it's a 30-year shingle and it's already, 15 years old, it's obviously lost some of its value that it had originally.
Perfect. Yep, you nailed it. All right, and is depreciation on the other structures typically recoverable under the other structures coverage? Let's see some hands. All right, Nicholas.
In my experience, it has been, but that's just been my experience.
Well, good. Yeah. So just in the claims that we see, other structures, things like your fences or outbuildings, many times can be actual cash value, and that depreciation is non-recoverable. But it's a good thing to pay attention to, right? It all depends on the policy. So again, the reason why I wanted to go over these questions is just as a little self-assessment. If you're unfamiliar with any of these terms, pay special attention to what we're going to cover here. So, all right, let's get into the meat. So in this portion of this lesson, we're going to talk about the insurance statement of loss. We're going to cover what it is, the different coverages you can find on it, and the different groupings you may see. And we're going to talk about how to understand insurance math and figure out the important numbers. We're going to look at the information we find in the summary pages. And then last but not least, we're going to talk a little bit about a stability scope and the information that you can find there. Now, covering that first question, what is a statement of loss? Again, you might hear it called a scope of loss, an adjuster's worksheet, or simply refer to it as your insurance estimate. Now, on that statement of loss, remember it's prepared by the adjuster after or during the inspection at times. And it's a document that after the adjuster is able to determine that a covered peril took place, they then review the policy and create this document to detail the items that are needed to repair or replace as a result of that loss. Now, being familiar with this insurance paper and being able to figure out what information it contains is important. And it's not just important for you in determining what was covered by the carrier, but it's also going to be really important for the homeowner. But here's the thing. The whole claims process is really intimidating for the average homeowner. And, some could say that's by design. Did you know that according to the Insurance Information Institute, only roughly 6% of all policyholders ever file a claim? So think about all the work that you do, all the insurance work. That's still only 6% of all policyholders. There's almost a stigma to it, isn't it? People are afraid that if they file a claim, they're going to be dropped by the carrier. And most people, they don't have an understanding of what their insurance policy even covers. So let's look at the traumatizing event of the storm. The homeowner has damage to their home, which is stressful in and of itself. They have no idea how to repair those damages or have no clue how to get the claims process started. And they have no clue what this hunk of paperwork means. They don't know what these line items refer to, what it means. They don't understand these dollar amounts. They don't understand what it's telling them. Is it covered? Is this something that they're going to have to pay? Who do they pay it to? Does it go to the insurance carrier? Or the deductible is deducted from this amount? Does that mean I've already paid it? What is this? Right? So this course is designed to help you so that you can explain the paperwork as the expert, and you can help assure the homeowner that you're there to help them return to their pre-loss condition. You can explain these numbers to them and what their responsibility is. So let's take a look at this first page here. So the cover pages, they may be slightly different based on the carrier and the format that the estimate was printed in. The statement of loss is basically going to outline the following information. First thing is going to be the carrier's information, or in some cases you may see the independent adjuster firm that wrote the estimate. Now in this case, we have at the top, Vogon Insurance of North America. If you guys are familiar with, now I can't remember the name. Arthur Dent, the guy going through space. I can't remember, of course. But if you understand that movie, you'll understand that reference. All right, so in this case, we have Vogon Insurance from North America. We also have the carrier's address and their phone number so that you know who to contact to confirm that they've received your estimate and to confirm the adjuster's information. Okay, so that's pretty standard, what you're going to see. Next, we're going to have the insured's information. So this shows the name of the policyholder and the property address. Now, this property address is the location of the loss, and it's the location covered by this policy in this statement of loss. Now, on the next line here, you see the home address, and this is the residence where the policyholder lives. And this is important to note because there may be situations where the property owner rents the home out, or it may be a summer home or a secondary home or any other number of situations. And we've seen it happen time and again, especially in hurricane areas, that maybe somebody owns several properties that are damaged by the same storm and they get their paperwork mixed up. So always pay attention that you have the correct statement of loss for the property that you're contracted to work on. Now the next section here is going to give you information about the loss. This gives you important information regarding the dates that the carrier was contacted, as well as information about the inspection date and the date that the estimated was created. All of that is here. Now, one of the most important details on this section is going to be your date of loss. Now, you're going to see that right here. And again, based on your format, you might have to look around for it a little bit, but generally on an exact estimate, this is where it's going to be. So this date of loss, this is the date or estimated date in some cases that the covered peril happened. Now this is important information to know because usually there's a 2-year statute of limitations on claims, meaning that if it's outside of that claim filing period, you may not be able to recover any depreciation. And we'll talk more about recoverable depreciation and what that means here in a little bit more detail. Next, we have our claim information. So this is going to tell you things like the claim rep. This is the adjuster handling the claim. We got denials. I don't know how this one's going to go. And then you'll typically have, their name, any contact information, etc. You'll also see the claim number the policy number, and possibly what the determined type of loss is. And you might see an introduction paragraph with additional information. You might see any specifics about the claim handling process and who to contact if you find additional damages. And this is where you may find a deadline to recover depreciation, is in this opening statement. Now, another important part of this page on the statement of loss right here is the price list. Now, having the right pricing information is critical to creating an accurate estimate. Xactimate researches and publishes a new price list monthly in North America, and fun fact, they publish one quarterly in the United Kingdom and Ireland. So in case you're ever deciding to work abroad, you know that now. Having the correct price list can in some cases make a huge difference in the estimate. Now, we've all noticed the price of lumber, as an example, fluctuate with hurricanes and with the pandemic. Xactimate researchers update their price list based on the averages for each city. So if an estimate's written in April and you're doing work in July, there could be some fluctuations and changes in the pricing. So again, they update that typically monthly, but I will tell you that during specific catastrophic events, they may release another price list. So that's something to keep in mind, because it's going to be referring to the pricing information of the materials based on whatever's going on and what their research has indicated. Now, how do you know if the most current price list or the correct price list is reflected on the estimate? Let me take a look here. So the first two letters of the price list code is going to tell you your state. So here in this example, we see our price list is for Minnesota. Our next two letters give us our local metro or city for the pricing data. So here we see MN for Minneapolis. Next is going to be details about either the version used, or you might see something else if it's a custom price list from a carrier. But typically for an Xactimate price list, you'll see the StateX. And then next, you'll see the month, and last, the year. So again, this is important to know that you have the correct location for your price list, and that you have either the month that the loss occurred or the month that the work's being done, however you're pricing it, and you can compare that to your statement of loss. So now we're going to talk a little bit about policy and coverages. And I will say this, we do, as contractors, there's only certain things that we can talk about with policy and only certain questions we can ask. We don't want to get too far into that. But there are a few key things that you have to have an understanding of to be able to read the statement of loss. So a policy can have different coverages with different policy limits for each coverage. And the one you're usually dealing with is going to be your dwelling coverage. That's what you guys are probably the most familiar with. And that's going to be for the home itself. Now, for your dwelling coverage, you're going to see a policy limit. And a policy limit is the estimated cost to replace that entire property. It's the maximum amount that insurance would pay in the event of a total loss. So if you think about it in terms of auto, if the car is totaled, it's whatever value that car is at. And if they pay replacement costs, they're going to cut you a check to replace that vehicle based on its policy. Now, when coverage is extended for a loss, the insurance company is going to calculate a replacement cost value for the property that has been damaged. Now, replacement cost is the cost to replace an item with a brand new version of that item. So for example, here we're in January, not too far away from Christmas. If this past December my Christmas tree was to have caught fire and damaged my sofa, a replacement cost policy is going to cover the cost to replace it with a new sofa. Next, we have depreciation that applies. So depreciation, again, this is a loss in value based on an item's age, condition, or obsolescence of the material. So for example, my couch, I've had it a couple years. It's a nice leather electric reclining couch, but I also have a 4-year-old boy and a Labrador retriever and a German short hair pointer. And both the boy and the dog like to jump on the couch when mom and dad aren't looking. So needless to say, the value of my sofa is going down the longer that I have it. Okay, so that's what depreciation is. It's devaluing that item based on how it's been used, right? Its condition or its age or obsolescence. Now, actual cash value is the item's current value in an as-is condition. It's the cost to replace the item minus your depreciation, so your garage sale price. So going back to my couch, if I were to put that couch on Facebook Marketplace, I might get $200 or $300 for it, even though it was much more new. And if I were to try to replace that same couch, I'd be paying a couple $1,000s, right? But because it's used and because you're selling it on Facebook Marketplace, garage sale price, you're not going to get as much. So for an example, when talking about roofs, let's say a roof with a total replacement cost value of $23,624.30 has depreciation of $966.73 apply, based on the roof's age, condition, or obsolescence of the materials. Now, if you subtract that depreciation from the replacement cost, you have the actual cash value of $22,657.57. Now, there's two ways that depreciation may be applied depending on the policy. First, we have recoverable depreciation. That's the good kind, right? That's where insurance is going to pay that depreciated amount once the items have been repaired or replaced. Now, we can typically see this indicated on our estimate in parentheses. So going back to our example here, our depreciation, that $966.73, we see that inside parentheses. That's going to indicate to us that our depreciation is recoverable. It's something that the insurance carrier is going to pay out. So an RCV policy, or replacement cost policy, is going to pay the full replacement cost, including the depreciation. And typically the carrier is going to release any depreciation funds, again, once those repairs are completed. Next, we have the not so happy kind. We have non-recoverable depreciation. So you'll notice that in this summary example, we have the depreciation listed inside chevrons. Like I said earlier, it's those alligator mouths chomping up the depreciation. And that means goodbye. These funds have been deducted from the value of the claim. And the non-recoverable depreciation is something that the insurance carrier does not pay out. Now, you'll typically see this on an actual cash value or ACV policy. But depreciation may also be non-recoverable if the claim has exceeded its time limits. So the important thing to note here is that even if all the work is completed, the only person who can make up that difference is the homeowner. The insurance carrier is not going to pay any more. Now let's look at some other coverages that you may see. Other structures, typically those are going to be your fences, your outbuildings, and any other structures that are separate from your main dwelling. Now, your policy limit for other structures coverage is based on the cost to replace it. And typically, again, you may see some different examples based on the types of policies that are written in your area, but typically from what we've seen, other structures is typically ACV. So check into that, especially if you're doing fences or if you're doing outbuildings or barns or other structures. You want to look and see if that depreciation is going to be recoverable. If not, again, remember the carrier is going to pay that garage sale price. Next, we have contents coverage. Now, contents coverage refers to the insured's personal property. So a good way to think about that is like if you were to take the property and turn it upside down and give it a good shake, generally anything that falls out would be considered contents. And of course, there's a couple of different considerations on that, but for the most part, that's how you would consider contents. Now, your policy limit for contents is based on the cost to replace them, and that's typically determined by an itemized list that's provided by the policyholder. And contents coverage may be RCV with recoverable depreciation, or it may be ACV with non-recoverable depreciation. Next, you may see endorsements or riders to the policy. So these are important to note because they can give the policyholder extended coverage, like building ordinance and law, otherwise known as building code coverage, which allows for an additional amount if needed to repair or replace items in line with your current building code. But they may also decrease coverage and exclude certain things, like you commonly see metal marring or pipe burst exclusion. So have a general idea at least of whether your depreciation is going to be recoverable or not, and know the policy limit or the coverages that you're working with. Right? If you only have a $6,000 other structure limit and it's going to cost $12,000 to get a new shed, well, carrier's only going to pay $6,000, right? So those endorsements and code exclusions, remember, those are purchased by the policyholder. And they may increase or decrease the coverage or policy limits, but the main reason that they're there is because they're going to increase or decrease the premium. Again, that's kind of what the policyholders are most concerned with in the beginning until they have to file a claim. So now that we've gone over some of the coverages that you may see listed on a statement of loss, we've talked about depreciation and how to identify whether or not it's recoverable. Now we want to talk about another portion of the funds associated with the claim, and that's the deductible. So this is Sarah. Sarah heard that 15 minutes could save her 15%, right? She met with an agent. She came home with a new policy that had a lower premium, but unfortunately it had a higher deductible if she ever has to file a claim. But she's going to go home and she's really not going to think about that deductible amount, just like every other average homeowner. So the deductible is, of course, the out-of-pocket expense that the policyholder pays for each claim. It's what they agreed to contribute to every claim when they purchase the policy. The deductible is the policyholder's responsibility. Now, the purpose of that deductible is so that the homeowner shares the risk. It's not just the carrier paying out for every claim. The homeowner has to have some responsibility in the repair. And of course, the reason why they choose that deductible is because it's either going to save or make a difference on their premium. It may be a negligible difference to increase it to a more manageable deductible, but they may get a considerable discount for getting a very high deductible. Now, of course, the higher the deductible, the higher the risk the policyholder takes on. And this is very important. The deductible is the policyholder's responsibility. So the policyholder must pay their deductible on every claim. The policyholder has basically made a contract with the carrier when they purchase their policy. And insurance carriers are financial institutions. So if the policyholder does not pay their deductible and they're in breach of the contract, they can possibly be pursued by the carrier for insurance fraud. So that's not good, right? And we want to make sure that when we're going over these numbers, we can explain this clearly to the homeowner. So we're going to take a look at a couple of different types of deductibles that may apply. So first, we have our set amount deductibles. And this just means that the amount doesn't vary. So in this case, we have a $1,000 deductible. You'll see a different deductible possibly for different coverages, right? And then you have percentage deductibles. These are usually a percentage of the policy face value. So you might see a 1%, 2%, or 5% percentage deductible. Next, you have your hurricane and named storm deductible. So while your dwelling coverage may have, a $1,000 deductible, in the event of a hurricane or damage from a named storm, the storm deductible would kick in and apply instead. And these storm deductibles, they're usually much higher, and they can be either a percentage-based deductible or a set amount. Again, they're going to be usually much higher than your dwelling deductible. So good thing to pay close attention to if you're working specific storm areas. So let's take a look at an example of how these numbers can play out. We're going to look at a policy with a $250,000 policy value. A 1% deductible is going to be $2,500 that the policyholder is responsible to pay for. 2% means that the policyholder is responsible for $5,000. And now let's say there's a 5% hurricane deductible. That's a whopping $12,500 that's coming out of the homeowner's pocket. This is again why it's important to read the insurance paperwork before you get started and make sure the homeowner is prepared to follow through the claims process. Now let's move on, and we're going to take a look at the rest of the paperwork here. So under each coverage at our grouping, here we see the grouping for our dwelling roof. Now we see the adjuster's sketch of the roof and the measurements. In this summary, we have the total surface area of the roof, 3,421.73 square feet. We have the length of the perimeter, the hip length, the ridge length, and the total number of squares. Now this section is important because it gives you your total surface area of the roof based on that sketch. You know by looking at this section that if down in the line items, the adjuster has not approved removal of 34.22 squares of roofing material, that they have not approved this roof for a replacement. So let's take a look now below at the line items. These lines are going to make up the components noted as the adjuster is needing repair or replacement as part of the damage to the roof. So this is where you would look to make sure that everything is accounted for. So for roofing, do they have all of the necessary code items listed? Do they have all the flashings and the correct materials listed? If you're working on an interior, are they covering the correct square footage of drywall replacement? Or have they missed the carpet tack strip entirely? This is where you find what's covered and you can review what's missed for your supplement. These detail lines are broken down by columns, as you see. And in this first column is the description. That's going to tell you the name of what each line item is. Your next column is your quantity. How much of each item needs repaired or replaced. And this is a great place to look to see if, again, they're covering the correct number of squares or if they're paying for repair per shingle. Next is your unit price. So this is the dollar amount for each unit of measurement. For instance, line 1 here, they calculate that the removal of 3 tab shingles is worth $45.16 a square. And the replacement of the power attic vent cover, for instance, is 81.43 each. So again, it's based on the unit of measurement. Your next column we see here is your RCV column. So RCV, again, is that replacement cost value. This is the total cost to replace the item. So in this example, we see the removal for 34.22 squares is at $45.16 per square, and that totals $1,545.38. These next three columns on this example go together. They detail the age and the remaining life of each item, and the condition, and the depreciation factor. Now, something to notice is depreciation should only be applied for physical items, not typically applied for labor. You can't depreciate or give a garage sale price for the act of removing the shingle or the act of replacing a digital satellite system. So let's take a look again at that RCV column. If you add the totals for this column, you get your total replacement cost value for the dwelling roof section of $12,053.45. Now, if you subtract the depreciation, totaling $4,229.30, you get your actual cash value, or ACV total, of $7,824.15. Now, again, the format of what you're seeing may look a little bit different based on the report type printed. You might not see the details of the depreciation, but for the most part, you're going to have some of this information available to you, right? You're going to see an RCV column, you'll see an ACV column possibly. Again, it just depends on the report type. Now, we've gone over this first little introduction to insurance math. So if you haven't glazed over by now, now's when we're really going to dig in so we can determine what all these numbers mean. And so you'll be able to verify and you'll be able to read the statement of loss summary page accurately. So the first part of the formula is the replacement cost, or the RCV. And remember, that's the total that it would cost to repair or replace the items before anything else is subtracted. Now, from the RCV, we subtract all the depreciation, both recoverable or non-recoverable. And that's going to give us the actual cash value. Now, to find out the amount that the insurance typically pays out on their initial payment, we would take that actual cash value and subtract the homeowner's responsibility, the deductible. And this is going to leave us with the net claim value, or net value of the claim. So again, the net value is the RCV minus the depreciation minus the deductible, or in short, it's the ACV minus the deductible. And this net value is, again, the amount that the insurance carrier sends out, typically with that first statement of loss. This is your ACV check. Now, to determine the carrier's full responsibility, we need to find out what our net claim value is. So to do so, we would add in any recoverable depreciation. So this net claim value is actually the total amount that the carrier is responsible to pay for the claim. Okay, so that's everything that the insurance carrier is sending out. So we're going to take a look at this in a real world example and look at how insurance math comes into play.
fi gata, cred că în vreo 5 minute.
So here we're looking at the summary for the dwelling coverage, and our line item total is $12,266.94. We have a material sales tax of $274.88, a total replacement cost value, so that RCV, of $12,000 $541.81. So that's your line item total plus the sales tax for your total RCV. Next, we have depreciation in the amount of $5,111.14. And we see here that because it's inside parentheses, we can smile because that depreciation is recoverable. Subtracting the depreciation from the RCV gives you your actual cash value or ACV value of $7,430.68. Now remember, we need to figure out the insurance carrier's responsibility. What are they going to pay? So next, we need to figure out, okay, who else is paying for this claim? The homeowner. So the policyholder's responsibility is our deductible. So for this claim, the deductible is $1,358.50. Now in this case, and as you may see in some of your handling, this is actually a supplemental statement of loss, meaning that there was a previous statement and previous payment. So we need to subtract the previous payment in the amount of $5,057.61. And this is going to give us our net claim remaining. So what this is the remainder of the ACV payments left. To find out the total that the insurance carrier has left to pay out, we need to add back in that recoverable depreciation, right? So let's do that. Now, in addition to our recoverable depreciation for $5,111.14, there were items on this estimate that were initially left out as paid when incurred. Now, when you see this on your statement, paid when incurred means that those items are only paid out once they've been completed or once the carrier has received notice that the homeowner has incurred that cost. So in this example, to find out how much the carrier has left to pay, we add the recoverable depreciation and the paid when incurred amount of $536.64, which gives us our net claim remaining if additional amounts are recovered. Now, what they mean by this is if the claim requirements have been satisfied and they receive the final invoice showing that the work has been completed and the paid when incurred items have been satisfied, they will release this $6,662.35. Okay, clear as mud? You gotta love insurance math. I joke with our estimators here all the time. I have to break out my calculator. I don't math. Can't do it in my head, but I know there's a lot of people who can, and kudos to you. So we've covered the summaries. We've covered the insurance math and grouping coverages and what the statement of loss is. But now it's time to put in some practice. So you have a couple of minutes here to work on answering these questions. I want you to open up your workbooks and go ahead and work on this exercise. So SOL exercise 1, 2, 3, and 4. Here's the pages that you can see them. I'm going to give you about 5 minutes to go ahead and answer these questions. And then what we're going to do is go over them together. So if you don't get it quite finished, don't worry about it. We are going to go over this as a group. And I will be asking for volunteers, so get your hands ready. I'm going to go ahead and lower everyone's hands for now. But it's 12:46. I'm going to give you 5 minutes.